Hello, international finance students. Today we're talking about the foreign exchange market. The foreign exchange market is like the stock market or the bond market, where you have buying and selling of things, right? And they're like the foreign exchange market is like the bond market and the stock market in that it's primarily a secondary market. Meaning, when you are buying shares in the stock market, you're not buying shares from the company that the company just created, typically, right? Usually you're buying them from someone else who bought them from someone else who, at some point back the chain, got those initial shares in an IPO or a seasoned equity offering or a private placement. Similarly, right, currencies exchange all the time, and so you're not likely to be purchasing currency from the country in question, but rather from some other party that had it for some other reason. And those currencies trade in a foreign exchange market basically all the time, right? So the stocks are they're traded all over the world, but a lot of the equities volume occurs in New York City and at a specific trading time frame. But currencies are traded around the clock all over the world. So just as an introduction to the foreign exchange market, we have some terms to define. So the first is an exchange rate, and an exchange rate is literally the price of one country's currency in terms of another. So I think the easiest currency to sort of understand this or to see it as an American is the yen. So for a long time, the US and Japanese exchange rate kind of hovered around $1 purchasing about 100 yen. And so, if you would see, if you watched a movie that was set in Shinjuku or something, and they had a price in a convenience store, and you had an apple that was 200 yen, then you could say, oh, that's roughly $2, right? Because it's 100 for one. And the exchange rate, the 100 for one exchange rate would be, the cost of $1 in yen, 100 yen buying $1. Lately, that's more like 140. So it's drifted since that period, but the point being, it's literally a price. It's like a price at the grocery store. If I want to, if I have $1 and I go to the yen store, which, for most people is a bank, or even, through their debit card, they will buy yen 140 at a time per dollar that you spend on something. So if you, run your debit card in that convenience store and buy that apple, it'll take your $2 and turn it to 280 yen, and then spend or I guess it would be something less than that, since you don't need 280 yen to buy a 200 yen apple. All right, it's just exchange rates are prices, but they're prices for currency, and that can be a little bit complicated to get your brain around because we're thinking of describing prices in terms of currency, right? So it is quite true that if you think about from the Japanese perspective, buying an American apple, if the American apple is $1, from the Japanese perspective, there's kind of two prices, right? There's the $1 per apple price and the 140 yen per dollar price. And you have to route through both prices to get your apple. So the foreign exchange market encompasses the conversion of one currency to another, and there's a whole bunch of different places this happens, at banking institutions, investors, industrial firms acquiring currency for trade purposes. There are multiple tiers to the market where you have spot trading and forward trading and derivatives trading. So the foreign exchange market is the largest financial market in the world by virtually any standard, meaning just in terms of the total dollar volume is much, much larger than any other financial market, right? So daily turnover in 2022 was $7.5 trillion. So there's lots and lots of currencies transacting in any given moment, and they can make a lot of sense, right? You can find the United States. Think about all of the goods that we import from Mexico, Canada, and China. None of those countries use our currency. So American companies either pay those companies in American currency, and then they exchange the dollars, the American dollars, for their own local currency to pay workers and suppliers, or the American companies are paying those foreign suppliers in foreign currency, which means they need to acquire Canadian dollars, Mexican pesos, and renminbi to pay those suppliers. So no matter what, there are foreign exchange transactions that either precede or follow an actual physical transaction, and it's in the same dollar amount as well, right? So basically any international economic transaction will need to route through the foreign exchange market at least once, and possibly more than once. So how does this market work? What does it look like? So there's a couple of things we can talk about. So first, there's it's multiple tier market in two dimensions. So there's a big difference between the market between large institutions and how that operates, and the retail market, right? So, for example, you can think, for interbank, the typical transaction size is about $10 million. Whereas if you think on the retail side, I'm not sure how common this still is, but it was definitely true when I traveled to Europe. As a young adult, that there were kiosks where you could do retail currency exchange, right? And you would hand in your physical American currency and get, at the time, Deutschmarks in, if you had physical Deutschmarks, right? Or in China, they give you physical renminbi, yuan bills to carry around, right? So catering to individuals leaving an airplane and catering to a bank are very, very different markets with different price structures, right? The transaction costs to getting currency at an airport currency kiosk could be as high as 5 or 6%, whereas those $10 million plus transactions, they measure currency costs in the not even in the 10th of a percent or the 100th of a percent, but in the 1,000th of a percent. So there's a multiple tier market in terms of the size of the participant, but also in terms of the complexity of the currencies or securities transacted, right? So a spot currency transaction is very straightforward. Spot just meaning now or today, right? So if I have dollars now and I buy yen now, that's a spot transaction, and it literally it occurs right now, and that's it. Whereas a currency forward might look something like, okay, well, I purchase yen, but for delivery in 10 or 14 days, and so no dollars leave my wallet now, but in 14 days my dollars are going to leave, and my yen is going to show up at exactly the exchange rate I commit to today. And you can imagine maybe that makes sense if I have, let's imagine I'm doing a large purchase from a Japanese supplier, but it's going to take some time, and I want to know with certainty my expenditure on that purchase. So I enter into a currency forward to pay yen, to purchase yen now, but not to hold it, but to just buy it in the future. So then I, have time to raise the U.S. dollars to do it, or just I can earn American interest, or for whatever reason, I'm just, I don't actually need the yen until the delivery is completed, so I can delay that. So those are derivative contracts, right? So you have to set that up. I mean, they're standardized contracts, but it's an agreement between lawyers, and so it doesn't make a lot of sense for regular consumers to do a forward contract, because by the time you've hired a lawyer to draft it for you or to verify that the standard contract you've grabbed is legitimate, you will have vastly overspent relative to just transacting in spot and waiting. But futures are settled, are mark to market. That's a derivatives contract. You post collateral and then it updates continuously. Those currency futures are practical for retail investors to participate in, and that's so you're settling in cash your local denominated currency, a currency movement. And then options are derivatives as well. And so an example of a important option in the foreign exchange space is it's called an Asian currency option. So you can think about so the Asian part is just a colorful description. What it actually means is a contract where the payout to the owner of the contract is dependent on the average price of a currency over the life of the option. So you can say, okay, I purchase an Asian currency option with a 6-month time frame, and if the foreign currency becomes too expensive, right? If it goes past if the average value of this foreign currency over the 6-month period exceeds some threshold, then I am owed some money. And that is a really important hedge purpose, because you can imagine, okay, if I'm an American company that I'm continually purchasing from Japanese suppliers, I'm constantly exposed to the yen, but not at any one moment in time. Some Tuesday, some Thursday, some Saturday, right? Over the course of this 6-month period, I've been buying yen to deliver to foreign suppliers over and over and over and over again. And so having an option that pays off based on the average price level of that currency is very helpful, because if the yen significantly appreciates over that time frame, all of my supplier contracts have now become significantly more expensive, but my option is also paying me a significant amount of money, and so it ends up effectively becoming currency price insurance in a way. Those are obviously very sophisticated contracts. So there's multiple tiers in that dimension too, where you have very simple spot currency transactions, and you have these derivative contracts with complex structures to try to facilitate the best possible risk management. And right, so at kind of all those two levels, right? So each different chunk of it is handled differently, or potentially differently. So we'll just start with the spot and forward markets. So the spot and forward markets are over the counter. I mean, there's no global clearinghouse for individual currencies. You can say, oh, well, I have an interbanking relationship with Credit Suisse, and then they, I ask them what's their quote on, the Swiss franc, and they tell me, and I could also, go to a different bank and get a different quote, and then do a transaction based on whatever quotes I've solicited. So it's right, there's not price transparency in those markets in that way. So that's why having like banking relationships or relationships with foreign exchange participants are important for spot and forward transactions. So it's a 24-hour market. There, so kind of the sort of three main chunks. You have the Australasia, basically Southeast Asia and the surrounding environments where there's a lot. I mean, there's a huge number of people and a lot of economic activity. Right, Hong Kong is very economically dynamic. Singapore, and Australia actually is, and in particular, Australia has a lot of raw materials exports that will then naturally require foreign exchange participation. So you have sort of that segment of the market that's going, and then Europe. So the euro is very important in terms of currencies, right? It carries a lot of weight. It's really useful for buying a lot of things. So when the European market's open, there's a lot of transaction volume there. And also, if you think about Europe, there's a lot of demand for foreign exchange because it's a very, well, first of all, being land connected to Asia and then having a wide variety of currencies in use mean having an active foreign exchange market is really important in a way that it isn't as much in North America, right? So in the U.S., we do have, the Mexican peso and the Canadian dollar, but I mean, so much of economic activity in North America occurs between Americans and therefore doesn't require involvement of foreign exchange. And even if you're dealing with a supplier in Ecuador, well, in Ecuador, their currency is the US dollar, so that doesn't require foreign exchange either. So of course, there's still plenty of foreign exchange activity in North America. It just looks a little different where so much of it you can get done without needing to do foreign exchange. The foreign exchange demand as a percentage of the economic activity, I think, is lower in the United States, in the North America. So currencies within these markets are typically priced and traded against the U.S. dollar, and there's a good reason for that. So markets are always thrive and depend on liquidity, and markets love transactions. The more volume there is in a thing, the more clear the prices are, the less it's less concerning to own the thing in question, right? If I buy something that trades every couple of weeks, well, that means if I need to sell it, I have to wait a couple of weeks, and then I get one offer, and maybe I don't like that offer, so then I got to wait a couple more weeks, try to get a different offer, or I got to pick the phone and try to, that's very different from, the stock market where there's, thousands of transactions every minute. And that's different than the foreign exchange market where there's vastly more transactions than that, right? So having a lot of volume is really, really useful. But of course, if I think about, if I'm, in Bahrain and I want to purchase the Thai baht, well, my currency is small relative to the broader foreign exchange market, and the baht is small relative to the broader foreign exchange market. So the number of people transacting between those two markets is going to be very small, which means it's illiquid. And what happens then is that it's more attractive and cheaper to transact into dollars, right? To go from, to go from Bahrain, the Bahrainian currency, to the US dollar, to the baht. And that just makes the Bahrain baht market even thinner, right? Because now you don't have people transacting that way either. They're just routing through the dollar, so it's even less liquid. So it's just basically a death spiral, and it doesn't happen. And so a huge, you can think about all the possible pairwise combinations of foreign exchange market transactions, right? All the possible currency A and currency B pairs. The huge majority of those, probably 99% of those pairwise combinations don't transact hardly at all. And to do that transaction, you just buy dollars and then buy the thing you want, or buy euros and buy the thing you want. So just because something's priced in dollars doesn't mean you have to purchase dollars. The euro is a common routing through currency as well. We'll look at some actual percentages later, but the point is, if I'm the Swiss franc, I have a liquid market with US dollars, I have a liquid market with the euro, and that might be the list, right? Maybe I have a liquid market with the yen and the renminbi and the pound, but I don't likely have a very liquid market with too many more currencies than that. So this chart shows the share of global reported currency exchange by country, this is important. Inter-dealer double counting is eliminated, right? Because if I'm a London bank selling to another London bank, that's just within the UK, so that's not counted here. It has to, be transacting with an entity outside of the local legal jurisdiction. And you can see pretty clearly from this chart that the New York City. So not in this chart, but New York City, right, is sort of the global hub of equities trading, and Chicago is the global hub of commodity derivatives and equity derivatives. London is the global hub of foreign exchange. Right? So 38% of all foreign exchange transactions route through the United Kingdom. Right. So, and of course they could be trading the pound, but often they're trading the euro, but in London. So the UK and the United States are number one and number two, but Singapore. If you're not familiar with what Singapore is, right? This is a very, very small place, but they have it's a very important port in Southeast Asia, where so much of the economic activity in Southeast Asia is foreign exchange dependent, and so Hong Kong and Singapore end up having a very strong global presence in foreign exchange, because so many people are interested in purchasing products from that region. And then you can see from there it goes smaller. So Japan, the yen, the franc, and France at 2%, China at 2%. All right, so as big as China is economically, it's not large from a foreign exchange transactions perspective. And that, has a lot to do with their very heavy currency restrictions on the renminbi. It's not legal to buy and hold renminbi to use as reserves to complete other currency transactions. So the Chinese government is not interested in French companies holding renminbi, so that if they need to buy the Swedish kroner, they can by buying renminbi first. Like, they're not interested in facilitating that kind of transaction, and they do their best to prevent it. And so, by choice, China is a much smaller player in the foreign exchange market than other countries are. You can see the highest volume in terms of foreign exchange is at the end of trading in Asia and at the end of trading in London, right? The end of trading in New York barely registers, right? So foreign exchange is very much centered more in Europe and Asia than in North America. But there's transactions at all times and in almost all places. You can look at the average turnover. So these add up to more than 100 because you have a currency in each side, right? So if the only trades that were happening were U.S. dollars buying euros and euros buying dollars, then the U.S. dollar would be in 100% of transactions and the euro would be in 100% of transactions, right? So these add up to 200 because there's two sides to each one. But you can see 88% of all foreign exchange transactions have U.S. dollars involved. And so, they kind of have this interesting sort of reality that the trade was probably done in London, but also probably done in dollars, right? So you have American currencies trading in London through London entities, and that's not an unusual thing, right? But so we have a ton. So if you've ever heard people in the news talk about the U.S. dollar being the reserve currency and we might lose our reserve currency status, that kind of language, this is really what they're talking about. It makes a ton of sense to just have dollars in inventory, because you can turn dollars in inventory into basically anything else you want in one transaction. You can have euros in inventory and turn them into European things, but that's and then maybe the yen, maybe the pound, but there's often the bulk of foreign currency reserves are held in dollars as the most convenient way to quickly get into another currency as needed. Right, these are big numbers. This is billion, right? So 1,000 billion is trillions. There's $6 trillion of daily foreign exchange turnover in dollars. Okay, this is broken down by pair, right? So perhaps not surprisingly, US dollar to euro is the most common pair. US dollar to Japan, number 2. US dollar to pound, right? So we have, kind of these reserve, right? I move from my one reserve currency to my other reserve currency. That would sort of describe these three. And then US dollar to Australian dollar. Again, Australia is a strong, vibrant, large economy. And same with Canada. This is China here, the Swiss franc, Hong Kong dollar, and then everybody else is 31%. So there's quite a bit in the long tail. But yeah, in terms of, right, so thinking about the liquidity, right? The dollar euro market is going to be very liquid. The dollar Hong Kong dollar market will be pretty liquid. But down in here, right, you probably have the Hong Kong dollar Swiss franc market at 0.06% or whatever it is, not very liquid. It's hard to get that transaction done. You would much rather do, get your Hong Kong dollars, buy US dollars, and then use your US dollars to buy Swiss francs. And that works better than trying to do it directly. It's also a tier market in terms of size. So we have 90% of trading volume comes from large commercial and investment banks that are making a market, right? Creating opportunities to buy and sell as part of their business. But it's not just these large banks that participate in this market. Mutual funds, pension funds, and hedge funds are often in a position of purchasing or selling currency, either to speculate or to keep for their own purposes. Mutual funds in particular need to have a supply of cash in hand to meet redemptions. So an open-ended mutual fund, you can get your money out whenever you want. And so they need to keep a reserve of cash on hand to meet redemptions. And then over the course, so if a mutual fund gets hit with a bunch of redemptions over and over and over again, it will shrink the size of the fund, but they'll pay out the cash first and then sell the securities in the mutual fund in an orderly fashion to replenish those funds. So let's imagine there's bad macroeconomic news and a bunch of Americans decide to get out of the stock market. Well, that's going to cause fund outflows from American stock-dominated mutual funds. Those mutual funds will deplete their cash reserves, meeting those redemption requests. And then over the coming days and weeks, they'll sell, stocks and bonds that they own, convert them to cash to replenish those reserves. Foreign exchange brokers who match buy and sell orders but don't carry inventory, right? So we're not owning currency and we're not a store. We're like a salesman, right? So we say, oh, hey, I have a list of people and I know what they have, and so you come to me and then I route you to where I know the currency is and where the exchange rate is good, right? So basically this is just essentially service providers, in organizations and individuals working as a service and providing information and transaction completion consulting. So there's a whole ecosystem around these big trades, and then the little trades also have an ecosystem, but it looks very different. So you have individual money managers, individual speculators, multinational corporations, right? So if I'm Inland Label in La Crosse, Wisconsin, and I'm shipping labels to Eastern Europe, I'm a participant in the European money market, but at very small volume. So in practice, I'm like a retail trader, because it's, I'm not, I might be only transacting in that currency with a few clients and a few customers. And so, and I'm not necessarily relative to the scale of, relative to $6 trillion, that transaction will be quite small. And so, it ends up routing through the same kind of things that the retail work does. So it's likely a business at the scale of an Inland or a La Crosse Technologies would work with a local bank that then would do some correspondent banking. So correspondent banking relationships are important here. So it's really a bunch of interbank relationships. Right? We've got commercial banks that have deposits in a whole bunch of currencies, and they can trade those deposits with each other, and that sort of creates a mesh of bank account, a mesh of organizations that can trade with each other and share currencies around with each other. And again, in a market, but this is an over-the-counter market, so they're talking to each other, and these currencies are buying and selling within each other. So international banks communicate with each other using what's called the SWIFT system. That's different from, so we have a separate system in the United States that handles, like if you write a check and then a bank is trying to clear the check, that works differently. And there, we have the wire system too. So there's a sort of bunch of different levels. And then I guess credit card transactions also operate in their own sort of system. So there's a lot of different layers to how these work, and they're different in, are transactions reversible? How long does it take transactions to clear? How expensive are they? That kind of thing. The clearinghouse interbank payment system is a clearinghouse for most interbank settlements. So you have a protocol to handle the transaction, and then a payment system to do the bookkeeping and recording. And of course, the key here, right, is that all these transactions have to be auditable, and, because in the event of, a double spend or some confusion, that, you can get in a situation where this gets litigated, and then you need to have, evidentiary support for the completion of the transaction on both sides. So, correspondent banking is in decline. So over the last decade, it's been about a 20% decline. Partly, these correspondent relationships come with risk, right? You have currency and inventory to support the operations of other banks, and then that currency falls, and so that introduces, foreign exchange risk onto these organizations' balance sheets. And so, some of them have been deciding that the risk of carrying inventory or holding currencies to participate in these correspondent banking relationships isn't worth it. And also, right, this, we're sort of describing, a technological system that makes a lot of sense in the 80s or something, where you have to keep a lot lying around because you don't know where it all is. But now with modern information technology, that's less relevant. So when we come back, we'll talk about the operations of some of these individual foreign exchange markets, and then do some computational work on exchange rates and multiple hop transactions.